Neil, we just had news in the last couple of minutes that the Chinese regulator is set to propose a 50% cut to car purchases, or to the car tax purchase. So this basically means that maybe the impact of a trade war is biting harder than expected. You also just see kind of China on all fronts trying to do damage limitation.
Exactly.
What if the China economy is much worse than expected?
Well, so we see this is the latest measure in a whole host of measures that we've seen over the past few weeks and months. Obviously, the big news last weekend was cuts in income taxes to part of a fiscal stimulus package. And, of course, the People's Bank's doing its part as well, starting to loosen monetary conditions, interbank rates in China coming down. So I think at the moment the sense is that the Chinese economy is slowing, it's weakening, it's not collapsing, so they can move in these measured steps. The question is what happens if that starts to intensify, and then I think it's only at that point we see a ramp up in these measures.
But what's the limit? How much can regulators and policymakers really do?
Well, they've got a lot, so they have a reasonable amount, I think, of ammunition. They've got plenty of space on the fiscal side of the balance sheet. The government's balance sheet's in good shape. There's some room for fiscal loosening there. The People's Bank, like I say, has been eased and they can do a bit more. And of course, the nuclear option is you let the renminbi go. You let the currency take some of the pressure. At the moment, they're trying to defend this line at 7. The question mark as to how long that lasts. I suspect they might actually end up dipping a bit below that, but let's see.